In June of 2016, UK voters voted in referendum to leave the European Union by a margin of 52% to 48%. The actual exit is still some distance away. The process won't even begin until the UK government activates Article 50 of the Treaty of Lisbon. And from that point, there'll be at least 2 years of complex negotiation. Now, given the scale of that task, 2 years to achieve exit seems optimistic. An extension is potentially possible, but only if the remaining EU members all agree. Post-exit, the UK will have to have some form of economic and political relationship with its neighbours, but the exact terms of that are going to depend on negotiation outcomes. The attitude of the other participants is going to be critical. In the meantime, the UK government is reaching out to businesses of all kinds. They want to know what the business community wants to see achieved in negotiation, and that includes grocery businesses, of course. And this makes sense, because the UK's membership of the EU has helped to shape the entire food and drink supply chain as we know it today. With only a few weeks' data, it's perhaps too early to see any lasting economic trends starting to emerge, but it is important that we're aware of several signs, both positive and negative. On the negative side, sterling values are down sharply versus other currencies, with likely inflationary impact. We've already seen some surveys showing a deterioration in consumer confidence, and there are other sources out there that suggest a parallel deterioration in business confidence as well. But those negative signs can be balanced out by positive ones. Share prices and house prices are all buoyant, and in some cases rising. Labour demand is very strong. Real wages are rising as well, supported by low inflation. And importantly, the Bank of England has indicated that it will maintain loose monetary policy, and that's critical because the survival and the strong performance of UK banks is going to have a powerful influence on overall financial and economic outcomes. It's too soon for us to draw any conclusions about the impact of Brexit on grocery. However, UK food and drink businesses should be monitoring changes in a number of fields. Broad European political change. Will Brexit spark further exits from the EU? Political change at home, with the position of Scotland in particular still under question. Food policy. As the UK leaves the EU, it will also leave the CAP. But what is that going to mean for land management and food production? Labour and migration. Will businesses still be able to recruit the workers they need? Regulation and law. Will we actually see those savings for regulatory compliance being achieved? And finally, of course, trade terms. Will we still have access to the markets that we need for both imports and exports? There's a lot of uncertainty around all of those potential outcomes, but to avoid being paralysed by indecision with respect to future decision making, let's focus on just 3 opportunities, 3 potential upsides for the food and drink business. First of all, food and drink businesses do have a chance to influence negotiating outcomes. So if your business or your trade association wants to feed in to government negotiating teams, now is the time to do that. The second opportunity is unexpected trade opportunities that might appear for UK businesses. The fall in sterling value means that UK-made goods are much more competitive than they were previously. And that doesn't just apply to export markets, but also to domestic sales as well. And finally, the UK has a chance to build a post-Brexit regulatory framework, and there is good reason for businesses to hope for regulation that is slicker and better suited to our own unique national needs. Again, that is a process that UK grocery businesses can get involved in today.